Hi everybody, I've added one more REIT into my Singapore portfolio. Today I'm going to share about why I add this REIT in, and I'm also going to review my entire REIT portfolio in this session. Before I talk about REITs, let's go through the portfolio performance. Currently, I have 12 Singapore stocks and 12 US stocks. And the new holding I have added in is CapitaLand Integrated Commercial Trust, which I will elaborate more later. These are my 12 Singapore holdings, and none of them have a weightage of more than 4% for the total portfolio. And the Singapore holding comprised of 31.95% of the total portfolio weightage, which means that I can add another 18% more to the Singapore portfolios. Next is my US portfolio, which also have 12 counter, and the highest holding is Disney, which is 4.92, and the weightage have been increasing as there is a significant price appreciation for Disney in the recent month. And the total portfolio holding for my US stocks is 40.87. You can see that my US weightage is currently much more than the Singapore weightage. One of the key reasons is US stocks have been moving very strongly, and the capital gain for my US stocks have actually outsurpassed the Singapore counter, which resulted in the US portfolio have a much higher weightage compared to the Singapore stocks. I currently still have a cash balance of 27.19%, and you may have noticed that the cash balance weightage have been slowly decreasing. One of the key reasons is I continue to add more positions to my portfolio, and another reason is there is a significant capital appreciation, especially on the US counter, which actually reduced the cash holding percentage. So the portfolio value now have surpassed 140,000, which is a new record, and hope that this will continue towards end of the year and also for 2025. The dividend collected since the portfolio started have more than 3,005, and you can see that a great increase in dividend over the years compared to 2022. One of the key reasons is the portfolio size have increased, and also more money have been invested to the dividend stocks. Now let's look at my unit trust portfolio. There is no changes for my unit trust portfolio for the month of November, and the portfolio value have crossed 65,000, and hope that this positive momentum will able to continue towards the end of the year and also 2025. Now let's talk about the REITs that I have just added, CapitaLand Integrated Commercial Trust. It is in fact one of the largest, or if not the largest, REITs in Singapore in terms of market capitalizations. And why I decided to add this into the portfolio, as I'm looking for a REIT that is Singapore focused, which means that most of their revenues and property are physically located in Singapore, and CapitaLand Integrated Commercial Trust have fit this criteria, where 94% of their property are physically located in Singapore. And I'm also looking for a portfolio that have exposure to office and also retail space, and CapitaLand Integrated Commercial Trust just now fit into my requirement. Currently, they got 21 properties in Singapore, 2 in Germany, which comprise about 2.6% of the total portfolio value, and 3 property in Australia, which about 3.4% of the portfolio values. The financial metric of CICT is constantly pretty stable and well managed. Currently, their average leverage is 39.4%, which is definitely not on a high level with a gearing cap of 50%. And their interest cover ratio at this current market juncture at 3.0 times, which is pretty respectable, where we can see that many REITs have fall below 3, and some even fall below 2.5 times for their adjusted ICR, which actually indirectly have breached the MAS requirement of adjusted ICR must be 2.5 times and above. They have also constantly maintained a very healthy fixed rate around 70 to 80%, and currently it is 76%. And another concern is I'll always look at their debt profile, as we know that REITs will constantly need to refinance their loan on a regular basis as they usually only take a short-term loan about 3 to 5 years. And we don't want them to have one lump sum of debt that need to refinance at a particular years. Currently, we look at their debt maturity profile, there is not a single year where they have more than 20% of their debt that need to refinance. We show that it is a pretty well managed risk on capital management. Another key point I look at when it comes to risk is occupancy rate. At this current market juncture, they are able to maintain a very high portfolio occupancy rate of 96.4%, which for me, when I look at risk, I usually look for 95% and above, which I will consider as very good management on that. And this will have been constantly maintain their portfolio occupancy rate above 95%. Tenant concentration risk is also one of the key criteria where they have no more than 5.2% of the rest rental income is from a single tenant. And the next we want to look at is that it have actually very healthy leasing activity where they have a very high retention rate of more than 80% of their tenant willing to renew their lease when the lease is due for renewal. Besides retention rate, I also want to look at, are they able to increase rent? And that is called rental reversion. This is a slide on the mall as a whole where they actually have suburban mall and also downtown mall, which they actually have a very good rental reversion for their suburban and downtown mall. This is also one of the key reasons why I buy CICT is that they have downtown mall where currently my risk portfolio do not have a holding on downtown mall plus office building in the CBD area, and this REITs have managed to fill up the gap for my risk portfolio. Let's look at this, how this REIT have performed. This is a year-to-date performance where I compare it with the STI ETF and also the risk total return index. As we know that risk was not performing over the past few years due to high interest rate, and thus I would not expect the risk to outperform the STI ETF, which is mainly driven by the banks. And we know that banks have a very good run, especially this year. But what I want to look at is how does this risk perform against the risk index, which comprise of more than 50% of the risk listed in Singapore. And from this side, you can see that this risk actually outperformed the risk index on a year-to-date basis. And if I will look at the time frame longer, it have also outperformed the risk index over a 5-year period on a total return basis. And let's track even longer. Since January 2016, the risks have also outperformed the risk index. And in fact, from the graph, you can see that the risks have most of the time constantly outperformed the risk index. This is one of the key criteria when I look at risk is that I want a risk that have able to consistently outperform the risk index in a short term, mid term, and at a long term period. So this is one of the key criteria I look at it when selecting my REITs. So this is a summary of my REITs portfolio currently where I have 6 REITs. The REITs that have the biggest holding is actually Parkway Life, which have 22.17%. And the REITs have the lower holding. Currently, the single digit holding is Fraser Centrepoint and of course the newly added CICT, which is 8.97%. From this allocation, you can see that actually the risk is pretty well balanced between industrial, office, and retail mall. As Ascender REIT is a industrial REIT, Mapletree Logistics Trust is also industrial REIT, but mainly focused on the Asia Pacific or the Asia region, where they comprise of 40%. Next, we look at Fraser Centrepoint, CICT, and Mapletree Pan Asia Commercial Trust, which are mainly office and retail mall, where they also slightly less than 40% holding. So it is a pretty well-balanced portfolio on that, and followed by a healthcare which have 22%. However, if we were to dissect further, especially on the industrial side, this portfolio is more skewed towards a logistics aspect, where Mapletree Logistics Trust is fully 100% logistics REITs. Ascenders, there is a percentage on the logistics side. There's one REIT sector that is pretty lagging, which is the data center REITs, especially when now AI is pretty hot now, and we know that technology will definitely advance and data center will be in constant demand all the while. And my district currently, the data center exposure is on a lesser side, where Ascender REITs although have data center, but it only contribute a low percentage to the total portfolio. And this is something that I'm looking to increase my data center holding along the way so that there will be more data center exposure in my current risk portfolio. However, I may not want to just zoom into the 3 data center focused REITs, like for example, Digital Core, Keppel DC REITs, and Mapletree Industrial Trust. I want to look it more globally, as you know that my risk portfolio is a Singapore and US portfolio. And if I look at the total risk portfolio as a whole, including US side, you will able to see that actually my retail side have further increased, as I have this reality income, which is 16.84%. Once I add in the US portfolio, you can see the retail and office side have actually become the more dominant player compared to the industrial side, which will be much lesser. And I have a tactical allocation, which is VG properties, which is more of an experiential risk, okay, which I explained in my previous video why I bought VG. Okay, it's more towards a tactical allocation on that. And thus, I'm looking to increase my holding on the industrial side to counterbalance off, and particularly on the data side. One of the risks that actually I'm looking at is I will prefer to buy into a data center REIT listed on the US rather than the Singapore side, which I feel that it has even better growth potentials. Yeah, better growth potential in terms of capital upside, and also have a better dividend growth potential. However, at this market juncture, the opportunity to buy is not right yet. So if I were to make any purchase on any data center REITs, I will update everyone in my future videos. That's what I have to share with you today. And if you feel that this video have benefit you, do remember to like, share, and leave your comment below. I shall see you on my next video.